Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. All right, it is time to get some grading done. This is one of my favorite segments, and for those that don't know, I started my career as a teacher before going into finance. So I taught in Dallas, Texas for 2 years, then moved to New York, got licensed, became an advisor, and did that whole thing. And today we're going to grade Liza Strickland's portfolio. You can follow her at Public at the link or at the handle on the top right hand corner. Now, remember the ground rules here. I do not know what the purpose or what the strategy is for this particular portfolio. I'm giving you my thoughts and reactions from it and what I think. This is not investing advice because, again, I don't know the goals. I have no idea how much money is invested in each of these, right? It could be $100. It could be 100%. No, not 100%, I guess. It would be, let's say, 85% in this one thing and 1% for everything else across the board. So again, just my high level thoughts, overview, and kind of, hey, this is what I'm thinking. If this were a client coming in to me, this is what I would say first before digging in deeper. So obviously take this as just my thoughts. If you value it, then you value it. If not, that's fine, right? So this is just what I'm thinking about when looking. So here are my first thoughts. As I'm looking at this, and I took screenshots so I can mark up on the right hand side, but I have Public up so I can do that as well. And the first thing I'm looking at, and I had to take different screenshots. So I've got 1, 2, 3, 4, 5, 6, 7, 8, 9 is Tesla, 10, 11, 12, 13, 13, 14, 15, 16, 17, 18. So I'm assuming it's 18 positions. Nope, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27. So I know that maybe my count is off by 1 because it kind of erased one of my marks, but that's at least, let's call it 25 to 27 different positions, okay? And then these are repeated, so these don't necessarily count. So we got, let's just call it more than 20, right? We got more than 20 different positions. I think, assuming that this is a new investor, someone who hasn't been investing for, let's say, 5 years, I think that's a lot. And the other thing that I noticed is that there may be a lot of duplication. So, for example, when I say that there's a lot, you want to know, and we've talked about this before when it comes to earnings season and knowing what is going on with the company and how they may or may not perform and all those types of things. It's hard to keep track of 20 to 25 different companies and understanding exactly what's going on. Now, that doesn't mean that what I'm seeing is good or bad. Honestly, if I'm looking at just the stocks, I like almost everything here. Like Tesla, I'm kind of shaky on. I'm just going to draw a straight line here. But a lot of these, like even I personally am not investing in Chevron, but it's doing well this year. I know you're making some money in that particular category. I think CVS is solid. I like Berkshire. I like this. I mean, there's nothing I just don't like where I can say immediately get rid of this thing. I know Prologis is a bit shaky, but I still like it long term. You got ExxonMobil. I mean, I don't see any flaws in terms of the quality of the investments that you have, even with Tesla. Like I can be lukewarm on it, but it's not bad. There's nothing again that's just outright terrible here. So these are all, I would say, quite good quality companies. What I did notice, and I see this, I'm starting to see a pattern, at least for people who submit, is the risk of duplication, the risk of overlap. And what that means is you've got one or more companies, and you definitely have, in this case, several ETFs that do the exact same job and thus increases your risk. So for example, things that stood out. I have Walmart. I have Costco. I have, what was it? I think it was Kroger. And I had Albertsons. So all of these have done pretty well because I'm just double checking to make sure I don't have another grocery store that I may have missed. So all of these are on paper, great for inflation, great for recession, just generally good, just across the board. I really like Costco. I like all of these companies, right? But if the grocery industry isn't what we expect it is, or if something goes wrong in that space, you have 4 different ways your portfolio can get hit. And I'm not entirely sure if you need all 4. Now, I don't know off the top of my head now I have a bias, right? I have a bias for probably Costco and maybe Walmart. So that's just me personally, but I don't think you need all 4. I mean, essentially, these two, they're not the exact same, but they pretty much are. Walmart is somewhat in its own category, but if I wanted to, because Walmart does own Sam's Club, I can put these in the same category. So if I want to have one large multinational grocery chain, I know they don't just do groceries, but y'all get the point here. For one large national retailer, then I could do one of the 2 of those. And then if I want a smaller one, if I want both, then I can get one here too and just reduce that. And the other thing too is I'm able to invest technically a bit more. So instead of, let's say I only have $100 to invest, instead of doing $25 for each of these 4, I can just do $50 to 2 of them and still get very, very similar returns. So again, I think that's a little bit of duplication. Very similar to when I said at the end of last year that I didn't want to do PayPal and Square at the same time. They both ended up being terrible. Thank God I sold. But imagine if I had both PayPal and Square in the same portfolio and I'm losing double at 60% a piece at a minimum. I don't want to do that, right? Now, again, I think all 4 of those companies are good, but I don't need to duplicate. I don't. If I have Walmart, the same things that's going to make Walmart profitable, the same things that are going to make Walmart good, quote unquote, is the same things that are going to make Costco good. I think Costco is a bit better in terms of how the companies run, but again, the same factors are still going to be the same factors across the board. So that's one. Now, the other one that I noticed was Chevron and then ExxonMobil for the exact same reasons. Now, again, both of these are doing well right now, or have been doing well this year. But again, it's like owning Coke and Pepsi to a degree. They're very, very, very similar. Oil was down, at least I think in the last last 24 hours or so. I saw a headline that said oil was down and gas prices are dropping. Now, I'm not here to say where gas prices are going and all that type of stuff, but again, do I really need both? I'm not entirely sure that you do. So those are the duplication piece for stocks, for ExxonMobil and the grocery stores. That was something that stood out to me. The other thing that stood out to me, 2 other things really. There's a lot of focus on dividends. So I know for a fact that this is a REIT. That's a real estate investment trust. I know this is a REIT. And REITs are known, and for those that don't know, I've done a video on REITs before. REITs are known to pay high dividends. I know AT&T pays high dividends. So it looks like you're shooting for a dividend portfolio. That's fine. That's fine. Actually, if that's the case, you're doing very well. AMT pays a good dividend. So if you are looking, so does Coca-Cola. If you are looking for, I want something that's going to pay solid dividends, I want to have companies that are going to do well consistently, I would give you an A on that part. I think you've done pretty well here. And then obviously you have a bunch of dividend ETFs, which brings me to my second point of this half of the video, if you will. Again, we're running into overlap. And that is something, again, that I think I've almost said in every grade video. And I want to show you exactly what I mean here. So let me go to, where is it? I have too many windows, and I don't know why I have so many. All right, so here, this is the exact same portfolio. Again, you can see where I just chopped it to fit in our screenshot. So I've got ITOT. That's Total Stock Market Index Fund. One of my favorite index funds out there. The problem is, one, this index fund is going to have everything that you see here with the exception of bonds, because bonds are not companies. Okay, so that's one, and that's fine to a degree. But if I have this, and I have the S&P 500 growth, and I have companies that do real estate, and I have companies that do energy, like for instance, I can almost guarantee you, this is VDE, I can almost guarantee you that Chevron and Exxon are both inside this ETF. So this is one level of duplication. I've got the entire stock market. Then I own Chevron. Then I own, in this case, I own Exxon, and I have a energy ETF here. I've got 4. I'm touched 4 times by this particular investment. And that's not including the fact that it might be here. I don't know that, but it could be. Where else might it be? It could be in a Dividend Aristocrat fund. I'm curious to see if it's there. So you're looking at 4 or 5 times that you could be hit. And that might not be something you're looking into. I know for a fact for Berkshire Hathaway, one of its holdings it's got to be Chevron or Exxon or Oxy. But that's a deeper level here. But off the top, there's a ton of duplication that would scare me if I were the person that was over this account. So I'm going to look this up real quick. VDE Holdings, and see what comes up. All right, so Vanguard, and again, this is what I hope to be a very good guess here. So it's going to take me straight to Vanguard's website. I would have preferred Yahoo Finance, but it is a Vanguard fund. Let's see, portfolio. Okay, so it's giving me basic information here. Here's what I want, portfolio composition. So we think that ExxonMobil and Chevron are probably going to be in that top 10. I would be shocked if they weren't. So 111 different energy stocks. Just give me the list. That's what I'm looking for here. Okay, gas, oil, which is probably why the fund, I would assume, is doing quite well. Here we go. ExxonMobil is the top one here. 20%. That is high. And in fact, if I just look at the top 2, we're looking at 36% of this entire ETF is in ExxonMobil and Chevron. So I've got 30% of this fund right here, of just this one, is in Exxon and Chevron. XOM and CVX, I think is what they were. So I've got 36% of it here. Then I also own it individually in my portfolio. And I know for a fact that I have it in this total stock market ETF. And that's just a few places. Just a few. And again, now I'm assuming that because we know oil is doing well or has done well up to this point, that's great. It works fine in a market like this. But it may not work fine should the market change. And we don't know where the person is holding for forever. We don't know if they're holding for a few months. Because about yesterday, right? So overall, that is something that I would be concerned about. Now, if you want to learn more about portfolio overlap, guess what? I actually wrote an article about this the other day for Business Insider. So I'll put that link in the description below. I don't know why I don't have this starting at the top of the article, but there you go. So it was a few weeks ago now. So I know a little bit about overlap and how important it is, which is why I wrote the article. Now, another thing too is just to give you a degree of overlap and what I mean by that. Here are 2 that are in the portfolio. So we have NOBL versus SDY, and I'll show you here. I think that was the Dividend Aristocrat Fund. I like that fund. It pays good dividends. So here's SDY. It's seems like an S&P dividend ETF, so that's 1. And then right here, ProShares, S&P 500 Dividend Aristocrats. So the aristocrats are really, quote unquote, the best dividend companies that have paid dividends for like 20 years or something in a row. So it's a really interesting fund, one of my favorite funds. I don't currently own it, but I do appreciate it. I like it, right? So if I'm just comparing just those two, I can go here, I can scroll down and look at that. 55% of these funds overlap, which means that 55% of the funds are the exact same. You're not really diversifying away from anything, because again, more than half the fund, if something happens in the dividend space, which I don't think will happen, but if it were, both of these funds are going to be hurt by that. If I were to move over to another 2 funds that are on that were in that portfolio, and I guess this one didn't want to save for me for whatever reason. So ITOT and VOOG. This was the total stock market fund. I think this was a growth fund from Vanguard. Let's see, let's go up 1. S&P 500 growth. So I already know that there's naturally going to be overlap because this has the entire stock market fund. Oh, the entire stock market, and it's going to have the top 500 growth companies, which again, I don't know how they define it. So if I hit overlap here, and I'll scroll down, again, 53% in this case. Really, once you get past like 10 or 15, that's, you know, you can get away with 10. When you start to get 15, 20, 25% overlap, that's something that you want to be concerned about. And this is at 53. And this is just 4 funds that I spotted without doing all the research, digging in deeper, because, it's a free video, y'all. So those were some of the things that immediately stood out to me, is that overlap. So the overlap can be extremely dangerous if the market does not go in your favor. Now, when oil is up, that might help you. Now, when dividend stocks are in fashion, that might actually help you. But you could be increasing your risk in a way that you may not be ready for. I would be extremely concerned, again, about how these ETFs, not just because they're Vanguard or anything like that, but how are all of these ETFs, not just the ones at the top, but the ones at the bottom, how are they allocated? And is everything 50%, right? So you could really consolidate a lot of these by selling off some and just taking the money and putting it into one of the ones that you like the best. Their performance might be the same, and that is something that I would strongly consider doing too, is saying, what is the performance between these two, and does it matter, and which one does the best, and can I just ride with that one, right? And why it does the best. So if we go, I'm going here to VDE. I'm going to compare it to VOOG, and then kind of do a multi-layer approach to this. So I'm going to chart right here. And these are just some things that I would just immediately pick up on and say, all right, well, we want to make sure that this is going to be helpful for if this were my portfolio, my kids' portfolio, clients, what have you. Okay, so I'm at Yahoo Finance. All right, so we've got the regular S&P 500 right here in light blue. I'm going to go ahead and get rid of that. And we're comparing with VDE. I think that was was that the dividend one, or was that the energy one? All right, so that's the energy one. I really want to look at VOOG. This is the S&P 500 growth. Okay, so to do that, let me hit full screen. And then I will adjourn class here shortly. All right, VOOG. There we go. Okay. All right, so this is VOOG. I want to see just the last 6 months real quick. Has not done well, and that might be fine, right? The whole market has probably looked a lot like this. All right, so we've got VOOG. We want to compare it to, let's say, ITOT. And let's also compare it to, I think it's the other dividend fund, NOBL. So, for example, there's a difference. That dividend growth, the S&P 500 growth ain't really growing. And in this environment, growth companies haven't done well. The just regular stock market index fund in the middle is down 18, which is where the stock market is. So it may not make sense in this market to, unless you're fine with that, hold on to VOOG. What if I could just take that money, put it here, right? What if I can look at some of the other dividend funds and see how they compare? So there's a lot of comparison work that I would suggest doing if this were my portfolio or if this were a portfolio of a client. So I'm going to cut the video short here because I think I've gone on for a while. Again, there are a lot of holdings. So what I would suggest is consolidate. I was not a spelling major or someone who writes nicely. Anyway, consolidate, reduce overlap. So I would say watch out for overlap. And I would say that quality is good. Quality is good here. I think that's the biggest takeaway. I don't see anything in this portfolio that is a red flag that I have to question. Like, hey, what are you doing? This, like, in terms of selecting, I think the selection is good. It's just maybe a little too much of good things. You can only have so much cake. So I think again, the idea behind it is good. I mean, the fact that you have energy. I mean, if you're going to be concentrated and overlapping in a space, energy right now might have been the place to be. So I think overall the idea behind all this is good, but you really, really, really want to watch out for that overlap. So for today's grade, I'm going to issue a C. The reason why, again, the selection is good, but the overlap is really out there. I think also it's just really hard for a beginner, which I'm assuming here, just for everybody, I'm assuming this is a beginner. I know it is because I watch and read the comments. But I think to start off with 25, it's very hard to manage and understand what's going on. Like, when is Walmart's earnings? How has their advertising business done? Is Sam's Club, the Sam's Club segment, is that growing? And how is that comparing with Costco? Like, it's just one company, right? And then you have to go through all of these. And not that you need to know the level that I have to know, since it's my job to educate people on it. So you have to be, knowledgeable to a 10th degree. But even if it's, a 3 out of 10 on knowledge about what's going on, that's hard to do, 25 times. It's a lot to handle. So again, issuing a C, I think, again, selection is good. I do think that you really want to pay attention to that duplication. So the way to do this, and it's harder when you got a bunch of them, is go to each of these websites. And the good thing is, because all of these are Vanguard here, you'll be at one spot. But go through, just like I did for one of the funds I showed you the holdings. See if you see some things that overlap. For example, this real estate ETF. Well, you already have Mid-America REIT down here. This is real estate. Is this inside of that fund? I honestly do not know, but that could be a thing. What about Prologis? Is it also in that fund? These are the questions that you want to ask. So consolidate. I don't have really a number to give, just because that gets into a more complicated debate on what is diversification and all that type of stuff. But you definitely want to reduce it down and make sure that you are reducing that level of overlap and making sure that your portfolio makes sense and that you can contribute in the ways that make it more profitable for you, and actually make more of a dent. So again, you're dividing whatever money you're putting in your dollar cost averaging between 25 different positions. That's really hard to do. So if we can condense that down just a bit, I think that makes more sense. I would not, again, this is not a hard and fast rule. This is just me thinking out loud. You can get away with, and it's not a recommendation. You can get away with just 2 ETFs. Okay, if all you did in life was just BND and just ITOT, you would actually be fine. Now, what percent, do you have 60-40 portfolio or 80-20, whatever? Again, that's going to depend on age. It's going to depend on when you plan to retire, a bunch of stuff. But you can get away with that. So, that being the case, having, I would estimate, more than 6 ETFs is a lot. I think that's extreme. So again, that's not a hard and fast rule. That is not a gospel, if you will. But I'm just saying, if you can get away with 2, more than 6 is a lot. And again, let's see how many is 1, 2, 3, 4, 5, 6. That's 6 on just the first page. 6. See if it's gonna let me erase. I don't think it will. This is 7 right here. 8. So that's 8. So I'm not saying just take away 2. I think there are several that we can take away, but 6 is a lot. And I say that because remember, each one of these ETFs are probably gonna have anywhere between 50 to 100 stocks a piece. So really, you got like well over 600 stocks, and some of them you may be duplicating. So that is it for me. I wanted to give my thoughts here. If you want your portfolio to be graded, feel free to comment below with your link from Public. If you don't have Public, I will make sure that I will put my link there. You can free share, you can invest however you want to invest, and we can grade. And then the last thing is make sure that you check out our members only content. I just dropped a video yesterday on Insider. I think it was yesterday. It was late. But I did a video yesterday on insider buying and how that can impact the stock market, and showed you my favorite resources for doing that. So we do a new video every week. I answer questions, go into much deeper dives, and do everything possible to help make you a better, more informed investor. All right, that's it for me. I'll talk to you later. Bye.